Hello and good afternoon, good morning and good evening everyone. Welcome to the last panel of the week on our global macro conversation sessions hosted in cooperation with UBS. This is a great honor to welcome this afternoon an outstanding group of policymakers, academics who are going to reflect on not only the pandemic crisis, but really the macro policy dimension to it on the monetary and the fiscal front. Our chair, Beat Sigenthaler, will introduce our speakers. I want to thank, on behalf of the Reinventing Portugal, all of you for having accepting our invitations. And I sincerely hope that we can meet again, hopefully next spring or next year again in Washington, where we always have this capacity to co-host this event. Beat, over to you, and thanks again for really joining us this morning, this afternoon, and particularly for Professor Wakatabe, who is quite late in Tokyo. Thanks so much. Beat, over to you.
Thank you very much, Mark, and thank you for the opportunity to moderate this panel. It's a great pleasure, the panel is on monetary policy in transition with a set of excellent speakers. I will just use the sequence as it is on the program in order to go through them. Please forgive me if I don't go through the CVs, but I'll just mention their titles, and anyway, they are very well known by all our audience. So first we have James Bullard, President and CEO of the Federal Reserve Bank of St. Louis. Then we have Masazumi Wakatabe, Deputy Governor of the Bank of England, Bank of Japan. in fact, then we have Mario Centeno, Governor of the Central Bank of Portugal, and as such a member of the ECB Governing Council. And finally, Felipe Larrain, Professor of Economics at Universidad Católica de Chile, and the former finance minister and vice president of his country. We have around a bit more than an hour, maybe 15 minutes. As Mark says, in Tokyo, it is quite late already, so we will not try to not stretch it too long, but we will ask each panelist to make a few short introductory remarks, no more than 8 minutes, please, so that we have enough time for discussions and questions. And to our audience, please do email me your questions, and I'll do my best to pick them up and pose to our speakers. We are very fortunate, thanks to Mark, to have three representatives from the main central banks, and Felipe from Chile. And all these central banks really have been struggling with to some extent quite similar predicaments, particularly in terms of inflation and inflation expectations that have been below targets pretty much anywhere. And the question, of course, is how to get them back. And it seems increasingly clear that monetary policy on its own will not be able to do the job without substantial help from fiscal policy. And there is various experiences in the countries and regions of our speakers. So what I'd like to do, let me go to each of the speakers first for their introductory remarks, and then after that first round, we will come back for questions and hopefully some audience questions as well. So let me go to the first speaker on the list, President Bullard, to give us his views on, of course, the US economy and the policy outlook there. Jim, please, the floor is yours. Thank you.
Thanks very much, and thanks to the Reinventing Bretton Woods group for inviting me today. This is always a very good discussion. I'm looking forward to lots of great insights on this panel today. I thought I'd use my time to just level set on the U.S. Fed's framework review and just give some of the highlights as I see them, and how I see this playing out going forward. So first of all, I think that the framework review was initiated I guess about 18 months or a little more ago. I think it was generally successful. I do think it's best practice of any central bank to do a periodic review and statement of what it thinks it's trying to do. And this is a good way to communicate to markets, but also to be reflective within the institution itself about how goals are going to be achieved. I would see the framework review as it came out as codifying many of the thought processes that were already influencing policy and already influencing decision making. But this process made that more explicit in our consensus statement that came out just about a few weeks ago. I think one aspect of this particular point in central banking is that the U.S. is leading on this. The U.S. will be the first bank that I'm aware of to publicly say that we're doing flexible average inflation targeting, as opposed to, if you guys, and I'm sure everyone here is well aware of how inflation targeting itself came about, but there you had experiments going on with smaller central banks. And eventually, and only after a very long time, did the U.S. come on board with inflation target, at least officially. I think unofficially we came on much sooner, but officially we came on much later. We didn't set an inflation target in the U.S. until 2012. So I think a good discussion here is that, is it a good idea or not to have one of the biggest central banks in the world leading here? I would say that the framework review did point out a widespread agreement, I think, across policymakers and across academics and others that are stakeholders in the policy process, and that is that the effective lower bound is causing downward bias in actual inflation outcomes in the US and around the world. So when inflation targeting was originally developed in the 1990s, there wasn't much discussion of the effective lower bound or the zero lower bound. And now that we've spent a lot of time there in recent years, it's become apparent that this is dragging down actual inflation outcomes. And the problem with that from a macroeconomist perspective is that it's difficult to maintain credibility for the inflation target if you're not hitting the inflation target. So in order to fix that, you have to do something. You have to take more explicit account of the effective lower bound, the effect that it's having on actual inflation outcomes, and flexible average inflation targeting is the response to that. Essentially means that you'll have some kind of makeup strategy. It's a step toward price level targeting or nominal GDP targeting, which often turns out to be optimal in models in the academic literature. When you get into actual policy making, you have to be more broad, big tent language, softer in your implementation. But the spirit of this is that you would make up for past misses on inflation by being more dovish after a period of missing the inflation target on the low side. So just the review did garner unanimous support on the FOMC. I think that reflects the thoroughness of the process. And I'll just highlight some of the elements. Certainly the flexible average inflation target is the one that gets the most attention. Type of makeup strategy over some time. These things are not precisely defined. They will be in the judgment of the committee, but the spirit, I think, did garner widespread agreement on the committee. I think we emphasized that the employment goal is broad and inclusive. I think that's important that central banks reiterate. I think that we care about everybody in the economy. This is macroeconomics. We care about every single person. We want to get the very best outcome that we can for everyone. And I think it's important to always be emphasizing that this is not a policy that's conducted just for some segment of the economy. It's supposed to be the best policy for the entire economy. The committee also said, and this will be good for this particular group here, that we would worry only about shortfalls of employment from full employment. So the shortfalls language, I think, is quite different from what we used to have, which was deviations of employment from full employment. So the shortfalls language, for those that are sort of model inclined here, means you have an asymmetric loss function. You care about unemployment when it's too high, but you don't worry about it very much when it's exceptionally low. And so I think that will change the landscape in central banking. It means that there's less emphasis on the Phillips curve. The evidence on the Phillips curve has been deteriorating for a quarter century now, and is quite weak at this point. There'll be less emphasis on a preemptive increase in interest rates to fight incipient inflation based on the idea that unemployment is low. That didn't, you can argue about the 2015 to 2018 period in the US where we did raise rates on that basis. But there'll be less emphasis on that kind of argument going forward. And finally, we included a better description of the role of financial stability in committee deliberations. This has been a concern at the committee ever since the irrational exuberance speech in 1996. It's continued to be debated and will continue to be debated going forward. I don't think we have great models of this, but it does enter into deliberations. And so I think it's important to have that be explicit in the longer run statement. And finally, my last comment is that the most common question here, so I'll preempt it, is, well, if you couldn't get 2% inflation, how are you going to get inflation above 2%? But I think that misses the spirit of this to some extent. The inflation outcomes that actually occur are a combination of the monetary policy conducted by the central bank and the shocks that hit the economy. And the way we've behaved since the 80s and 90s is that if there was any sort of shock that threatened inflation, we would be very aggressive in reacting to that shock to tamp down the incipient inflation that might otherwise develop. And the sea change here is to say that you're going to try to take more advantage of those reinflationary shocks. When they occur, you'll be more dovish in that situation. And it could be that such a shock is occurring right now. We've got massive fiscal deficits, bottlenecks in parts of the US economy, and obviously the Fed trying out a new strategy. So maybe we'll get to test out this theory very soon here, but I would say more likely it'll be over the next 3 to 5 years that we'll be able to see whether this works or not, and whether we can get inflation to run above target for some time in order to offset some of the past misses that we've had to the low side, and therefore be able to cement inflation expectations at 2% as we have promised.
Thank you very much, President Bullard. Before coming back right away to some questions, let me go first to our second speaker, Deputy Governor Wakatabe. Of course, the Bank of Japan is the one central bank with the most experience in low inflation. So we're looking forward to your comments. Please, Mr. Wakatabe.
Thank you, and good evening from Tokyo. Okay. I ate my dinner already, but I didn't have any alcoholic beverage. First of all, I'd like to thank Monsieur Mark Zhang and the Reinventing Bretton Woods Committee for having me. It is truly a great honor to be a part of this conference. I gather that the overarching question of this session may be summarized as, what is the shape of central banking or monetary policy to come after the COVID-19 pandemic shock? it is not entirely clear right now what shape of central banking to come, mainly because the impact of the current pandemic is hard to know. But I would like to emphasize there will be a great deal of continuities amid these changes. So let me break down this question into three categories: policy objectives, intellectual foundation, and the relationship with the government. For the first point, let me emphasize that central banking is the ongoing project, so that it has been changing and evolving throughout the history. We now cherish price stability, and for the Fed's case, the maximum employment. But these objectives are historical products. Turning to the current crisis due to the COVID-19 pandemic, throughout the world, a great number of businesses have been forced to halt or be shut down, and a number of people has lost jobs. At this critical juncture, it is imperative for policymakers to maintain businesses and people's employment and income. So central banks also should pay more attention to bankruptcies, employment, and income. Unlike the Fed, the Bank of Japan does not have maximum employment as our explicit mandate, but the Bank of Japan law stipulates the bank to achieve price stability, thereby contributing to the sound development of the national economy, which implies that the bank must pay close attention to businesses, employment, and income of the people as well. Now, having said that, the maintenance of financial stability and the price stability is still critically important during the COVID-19 shock. The maintenance of financial stability requires the central bank to act as a lender of last resort. Now, due to the ever more globally connected financial markets, now central banks are evolving to the market makers of last resort or the global lenders of last resort. So central banks around the world are cooperating with each other using swap and other arrangements. Now, also, the maintenance of the price stability is extremely important to maintain employment and income. Now, Jim said that we have less emphasis or the less evidence, more evidence to say that we can rely on the fiscal kind of relationship. But nonetheless, coming from Japan, I would like to remind you that the deflation is really, really dangerous. So it has severely damaged the Japanese economy and the people. So in this regard, I will touch upon the issue of the so-called side effects. After all, that we have more experience than other central banks on this side effects topic. Any policy should be judged by its net effect, so benefits over costs. In Japan, we have engaged in monetary easing for an extended period to achieve 2% inflation target. So some are worrying about the side effects on the functioning and sustainability of the financial markets and the institutions. And their concerns are understandable. But the benefits of the current expansionary monetary policy in Japan far outweighs its costs or side effects. Before the COVID-19 hit, thanks to the monetary easing, the nominal GDP in Japan has resumed growth, and deflation in the sense of the continued decline in the price level has been ended, and people's employment and income have increased, while the financial institutions in Japan are largely well-funded. Now, of course, that we can talk about the problems about Japan's financial sector and financial institutions, but they have a lot to do with the structural issues such as demographics, shrinking number of corporations in Japan, and also the savings and investment balance in Japan. Now, in fact, the Japanese case has shown that monetary easing could be maintained for an extended period of time. So if we want to continue the expansionary monetary policy, Japan shows that we can do that. But however, of course, we are carefully monitoring the possible side effects, financial stability concerns, or otherwise. So, and we have made and will make necessary adjustments to policy if necessary. For the second point, the intellectual foundation, that with the current trend tilts the central bank's approach toward a more data-oriented one rather than a theoretical one. My answer is yes and no. It is true that the COVID-19 shock has invigorated the interest in high-frequency data to grapple with a rapidly changing situation. Now, after all, we have to trace the impact of the COVID-19 pandemic on daily basis. We are now monitoring people's movement and the purchase patterns more closely and frequently. But I must say that these data are not seasonal adjusted and have their biases. Therefore, central banks use macro statistical data as well, and we use both data now. So this the emphasis on data goes hand in hand with the recent shift in economics toward more data-oriented empirical science. But we still need a theoretical framework to know what to look for in data and guide monetary policy. The theoretical foundation upon which current monetary policy is built is still useful, in my view. For example, the modern framework-based monetary policy exemplified by flexible inflation targeting does care about the question of credibility of policy and the expectations of firms and households. So there is strong evidence that monetary policy works best when it is credible and it influences on expectations. Severe deflation during the Great Depression of the 1930s ended when there was a decisive shift in monetary policy regime, which changed deflationary expectations. While high inflation during the 1970s Great Inflation ended when there was a decisive shift in monetary policy regime, which changed the inflationary expectations. Let me just give my thought on the so-called moral monetary theory here. I found the so-called MMT rather lacking, precisely because the MMT does not address these issues, credibility or expectations. And I must say that there are certain aspects that which are quite interesting, but I'm not sure that the MMT really has any theory of determining price and the price level. So I am inclined to agree with William Boiter and Catherine Mann. What right is not new, what new is not right, and what left is too simplistic. Now, on the third point, I must hurry up. There is a strong case for closer cooperation between central bank and the government during crisis time. But again, this is not new at all. During crisis, the government and the central bank must cooperate closely with each other. This is necessary given the division of labor between two entities. After all, central banks can provide liquidity and money, but they cannot spend money. Only the government and the private sector can spend money. Central bank independence is just another name for institutional arrangement to secure this proper division of labor. However, at this juncture, I think one may have concerns about the erosion of the proper division of labor during crisis time. Now, on this point, one may find the joint statement between the Japanese government and the Bank of Japan back in 2013 rather interesting and useful in ensuring the proper division of labor. In that document, both entities, the government and the central bank, the BOJ, commit themselves to work together, at the same time clarify their own roles to end deflation and resume economic growth. In that, the BOJ is responsible for achieving 2% inflation target, and the government is responsible for fiscal and growth policy. The current pandemic has impacted the economy and the society enormously. It also highlights the underlying issues such as stagnation, income disparity, and public health. So it may be necessary for central banks and the governments to agree on Japan's 2013 joint statement-like arrangement to tackle the current crisis, to secure the proper division of labor. To recap, central banking project is constantly evolving. So it is not entirely clear that the shape of central banking to come after the COVID-19 pandemic, but there will be a great deal of continuities with the current framework in terms of policy objectives, intellectual foundation, and the relationship with the government. Thank you for your attention, and I'm now looking forward to having a discussion. Thank you.
Thank you very much, Deputy Governor Wakatabe. Before we go to that discussion, we have our third speaker, Mario Centeno, Governor of the Central Bank of Portugal, and of course also former Eurogroup President. Please, Governor, the floor is yours.
Thank you. Thank you to you, Mark, for the invitation. Of course, thank you for the Reinventing Bretton Woods Committee for having me. And to you, Beat, for the difficult role you have this afternoon in dealing with this session. It is a pleasure to be among such a distinguished set of panelists. Jim, Masazumi, and Felipe, they all had a lot of expertise and experience to this. I'm going to try to add my own scoop. Well, we all know that this time is different. We have been saying this quite some time in facing the huge crisis in the last decade. But this is indeed a sanitary crisis that turned into an economic recession. It was unbalanced across sectors and with harsher consequences in some countries. We already know that. But looking from a European perspective, I think it's very important to put things as follows. The lack of initial imbalances was key. European countries were indeed reducing risks, and convergence across countries was really underway. And the shock, being exogenous, implied a lack of moral hazard concerns that usually is typical in European policy debates. These ingredients made possible this time for Europe to move monetary and fiscal policies independently together. This was kind of a very important and, in my view, impressive way of policymakers in Europe to decide this time around. In Europe, monetary policy response was quite strong, stabilized the financial markets, and provided abundant liquidity to economic agents. This was absolutely key in understanding the answer of Europe to this crisis. On the fiscal side, the process was led by an initial agreement at the Eurogroup level that I had the privilege indeed to conduct. 3 backstops and 540 billion euros in less than 10 days agreed among European countries is kind of a unique situation. And afterwards, leaders agreed on a wider package of 750 billion euros. This, together with the national responses to the crisis, mean that in less than 2-3 months' time, Europe was able to put almost 6 trillion euros in the response to this crisis. In my opinion, this is precisely what explains the leap of confidence with which our economies began to recovery, the long escalate, and so far, so initially, all initial forecasts were beaten by this response, this very quick response in our economies. Of course, don't get me wrong. Let's not fool ourselves. We all know that the last mile is the most difficult to cover when we face very difficult recessions. And let me here put 3 quick remarks on this issue. One is in the reallocation of resources, then the debt sustainability issue and convergence. These are three very important issues in Europe because structurally Europe is considered an economy in which reallocation of resources end up being slower. Debt sustainability issues are quite often raised in Europe as well, and convergence is still a very important topic for us. So all crises entail some form of reallocation and structural change. The sudden stop and go observed so far resembles a V-shaped process, but again, reaching the top requires an increase in labor market churning. And this comes always full of risks. But we need to promote it in order to return to the previous, to the pre-crisis GDP levels. This eventually requires a departure from protection of existing jobs to the support of new hires in the most dynamic sectors. The second issue is debt. Economies are getting out of the woods, but with higher debt. Sustainability is dependent on the decisions taken at this exact stage. A wise usage of the funds that buttress growth will allow our economies to overcome the debt problem. After all, debt is sustainable if the debtor generates sources of income, and this is very important at this stage for all of us to face. Finally, convergence. At the national level, an inclusive recovery has to be envisaged, but the level playing field must be secured at the European level. Measures have been adopted to ensure that the convergence process is not disrupted. All European policymakers are working together on this to this end. The next generation EU programs are key to achieve that goal. I think this is also an important issue at the global level. The IMF World Economic Outlook suggests a growing divergence in the world with increased poverty, and this is something that we need to care about and take this quite high in our agenda. Well, these are, in some sense, medium to long-term concerns as well. In my opinion, the premature withdrawal of monetary and fiscal stimulus can be detrimental to the rebound of our economies. We need to keep them for as long as they are needed, while adjusting the scale and targets, of course, to the challenges ahead. And in that, let me cite very briefly five topics that I think are important for us to discuss. First, curbing negative incentives. This is crucial for the success of our policy. And with uncertainty comes risks. Risks that may be harder to perceive at this stage, but may materialize at a later stage, shall be part of central bank's analysis. Policies should be designed or redesigned to mitigate such risks. Second, the monitoring of the implications of quantitative easing on liquidity in the form of safer securities is important. A shortage of good collateral that is essential to operationalize a multitude of contracts in financial markets could be detrimental to a proper functioning of financial markets. Third topic is what we call the reversal rate. The Eurosystem has adapted the implementation of its negative interest rate policy, implementing a two-tier system for remunerating excess reserves, whereby a multiplier of required reserves is exempt from the negative deposit facility rate. So far, the positive effects of negative rates have exceeded their side effects. Current estimates suggest, indeed, that the ECB has not reached yet the effective lower bound of this rate, but this can be a matter of concern. Fourth, let me also call your attention to the possible movements of search for yield in a way that they can not, or we should make sure that they do not threat financial stability. especially if agents have myopic expectations and expect low interest rates for too long. This is an important issue as well. Finally, and to finalize, let me call also your attention that in case of need, a set of macro-prudential and micro-prudential policies is still available. These are directed at banks and borrowers, helping to address sector and country-specific financial stability risks. Again, if another target policy responses are needed, they will certainly be analyzed by the Eurosystem. To conclude, all instruments are needed. The current crisis cannot morph into a financial crisis. This is and still is a big concern. For that goal, it's crucial to preserve the role of our financial institutions. And what I can assure you is that the Eurosystem will be doing that top in its agenda. We are right now starting or restarting the monetary policy strategy review that will take us for quite some time, or the next few months, and maybe in the spring or in next fall, we will be able to discuss that in more detail. Thank you, Mark.
Thank you very much, Governor. Let's then go over to our last speaker, who is Felipe Larrain, as I said, former finance minister of Chile, for a perspective maybe from across the aisle, so to speak, on the fiscal rather than monetary policy side. So from Santiago de Chile, please, Professor Larrain.
Well, thank you very much, Beat. I'd like to also thank Mark Uzan and the Reinventing Bretton Woods Committee for inviting me here. It's a pleasure to be with this distinguished group of speakers. And I hope to bring in not just a bit of a fiscal view, but also an emerging market view. You are speakers here are working in developed markets, which is a kind of a different reality from what we have in the emerging markets. So I will do a little bit of both, bring in what is the difference between the emerging markets and what's happening in developed markets. The first and starting point is that this crisis is deeper and more generalized than even the Great Depression. Not deeper, but just more generalized. Just to give you a figure, 93% of economies in the world will be in recession in 2020. That figure was 84% in the Great Depression. This is by far the most synchronized recession that we have in over 150 years. The second is that there is a very deep recession too, not as deep as the Great Recession, as the Great Depression, but the recovery is being so far quicker, though it will take time to be completed. Just to remind that in 2008, 2009, that what we call the Great Recession or the global financial crisis, a complete recovery in the G10 took 14 quarters to get back to the original level of GDP. So in this scenario, what we'd have is an unprecedented monetary expansion and an unprecedented fiscal expansion. In fact, both policies working together. The biggest effect was in the second quarter of this year, where the four major central banks increased by $3.8 trillion the liquidity in the system. And so far during 2020, the Fed has expanded the balance sheet by about $3 trillion, which is a huge amount. The euro area somehow less than that, but very significant amounts. This unprecedented action has helped not only the developed markets, but it has been a very important cushion for emerging markets as well. EMs have also injected liquidity, and I just, and allowed the exchange rates. This is a very interesting thing because emerging markets have allowed the exchange rates to depreciate. They did not fight the increasing interest rates to avoid capital outflows. It is a different response than during the financial crisis and during previous crises. So yes, this has helped. On the qualitative side, we see new instruments, new mechanisms. We have, for example, now forward guidance. We have massive asset purchases. And what do you do after driving interest rates to zero? Well, some countries go to the massive asset purchases, the other go to negative interest rates, direct lending to financial firms, even loans to small and medium-sized enterprises. The difference between developed markets in this regard and EMs is very high, is very large. First, on the size of the packages, much higher in DMs as a share of GDP than on emerging markets. For example, in emerging markets, the median increase in the monetary base is about 11% so far in 2020. And this goes from 3% in China to 70% in Turkey. On the types of instruments, they're different, they're more limited in emerging markets. Yes, we have, some unconventional tools that were not used during the Great Recession, like the purchase of government bonds and corporate bonds. Some countries in the emerging world have used macroprudential policies to support credit. And this is an important thing, is the regulatory process trying to make sure that credit flows to the economy. But it is fair to recognize that emerging markets have much more limited room of maneuver. Let me just say something about in terms of the inflation effects and price effects. The excess liquidity, one of the questions that we were put here was how long can QE and extremely low rates be maintained before adverse side effects? We are already seeing, especially in developed countries, some effects on, for example, on asset prices. We have effects on bonds prices, stock prices, and real estate. For example, housing prices in August of 2020 have increased by about 10% year on year in the US, New Zealand, and Canada, and about 5% in the EU and the UK. Inflation, these are in asset prices. How about inflation? Inflation and inflation expectations are already moving up in some developed countries, but not in Europe and Japan. Inflation in Europe and Japan is much more subdued. For example, the US inflation expectation on the 5-year inflation swap is at 2.2%. So it's right above, slightly above the 2% target in the US. So in most emerging markets, we have real interest rates negative. Emerging markets are not moving to negative nominal interest rates, but yes, to negative real interest rates. We have nominal interest rates at 200-year lows in the US, with a yield on the US 10-year treasury bond below 1%, in fact, closer to 0.7, 0.8%. Fewer central banks are cutting rates now in the emerging world. Most did this very quickly at the beginning of the crisis. So that's another important part of the response. On taking away the monetary stimulus, let me just say, at some point, it will be necessary to phase out the unprecedented monetary stimulus. Of course, and I echo Mario's point here that it should not be taken away too soon, because that may be a big problem. But it cannot go on forever. It is interesting that during the 2008-2009 crisis, there was a huge increase in balance sheets, a huge lowering of interest rates, and only a mild reduction of balance sheets from 2015 to 2019. So huge expansion and then only mild reduction after this. On the cooperation between fiscal and monetary policy, it is interesting to see that in all the world, and this is an emerging market feature too, they have both been extremely expansionary and they have complemented each other. on the regular cycle, we are used to see that if fiscal policy becomes more austere, that leaves room for monetary policy and vice versa. Now we have both, pushing through at very high speed. The central banks in the developed countries have been purchasing bonds. This is part of the cooperation between fiscal and monetary, purchasing public bonds, helping to take away pressure on interest rates. This is also an issue in the developing world, in the emerging countries, that emerging markets are also purchasing government bonds, helping to cushion the effect on interest rates. Let me finally speak a bit on fiscal policy. Once again, this unprecedented size of fiscal packages that we're seeing, that has increasing government spending, increasing transfers, reduction of taxes, guarantees, below the line stimulus. This is an unprecedented response overall, but much larger in developed markets than emerging markets. What we see here, and there is also wide differences within the emerging market group, because some of them, these countries, have very limited access to financial markets. So they cannot have a very expansionary fiscal policy. It is estimated that about 1/3 of emerging markets entered the pandemic with high debts and little or no room for additional fiscal expansions. So that makes a big difference for, let me say also that we have seen with this massive increases in debts and deficits that we're already seeing downgrades in many countries already. Tens of countries have been downgraded, and a few have lost investment grades, that had before the pandemic. Now they don't have it. So what is the risk? Once again, what we see is that at some point, these transitory packages need to be taken out, need to be phased out as the economy starts to recover. Not too soon, but not too late, because once again, one of the issues raised by previous speakers was the issue of fiscal sustainability. We cannot keep forever these packages, these stimulus packages, with the risk of downgrades, of fiscal unsustainability, of losing. For many countries, it was very tough to get investment grade, and now they don't have it. Let me say also that a final issue is a political issue. I see that there is more political pressure on the fiscal policy than on autonomous central banks. So in a way, I'm not saying that you don't have pressures, but we have 3 central bankers here in this panel. It is different, the political pressure that you feel probably on the fiscal side than with autonomous central banks. So let me stop there, and I look forward to a very fruitful discussion. And Mark, I also say this, I hope the next time we can be in person. Thank you.
Thank you very much, Felipe. Let me do, I'm a big fan of the ECB press conferences, and there every journalist gets 2 questions. So we'll just in that spirit, I will try to ask 2 questions to each of our panelists, starting again in the same order as we had the initial intervention. So starting with President Bullard. The strategy framework review, you mentioned it was very successful from your point of view. I guess in terms of the market perception, it's fair to say that it's been a mixed reception, because the credibility of that average inflation targeting is not, or let's say, or the overshooting of the target is not taken as a given. And one specific point that is being made is that little has been said or communicated about the practical meaning. So how, what kind of levels are being targeted, for how long is the overshooting being intended once it comes. So why has the FOMC not said more about these questions? And is this simply because it hasn't been discussed at this point yet fully?
Yeah, it's a great question, but I do think everyone has to be patient with the committee. It is a big committee by design. It has many voices. And so when you're going to come to something like a discussion of a long-run framework, you're going to have Big Tent language. You're probably not going to have a lot of explicit formulas or explicit numbers. Those would be reserved for the judgment of the committee at various junctures as we go forward. But I don't think that should blind financial markets to the fact that there was widespread agreement around this framework review and widespread agreement that we should try to target inflation higher than our long-run target temporarily to make up for past losses or past misses to the low side. And that is something that was not part of the Fed's playbook in the past. So this very much is a sea change. Yeah, I don't blame financial markets for saying, gosh, we haven't seen much inflation in the last couple of years. You know, why would it be different this time? But I did give you a scenario. You know, what this means is that we'd be less likely to react sharply to a reflationary type of shock. We would just let it ride and let inflation go above target and let it remain there for a while. And again, it's all going to be in the judgment of the committee, but there's also widespread agreement to go ahead and do that. So we'll see what shocks come as we go forward here, but we are in an era, as all the speakers have emphasized, of unprecedented deficits, easier monetary policy globally. Pandemic will come to an end at some point, and you've got an awful lot of fiscal stimulus in train here. So maybe we'll get the opportunity to test the theory very shortly.
And the second question would be that in your recent communication, President Bullard, you have been, I guess, one of the more optimistic members of the FOMC, if I may say so. But still, the question would be if the FOMC was deciding that further action was needed, and of course the market has been debating a lot what those next steps could be. What would your own preferred tool be? I mean, is it kind of as obvious as shifting the QE purchases towards longer maturities? Is this something that makes obvious sense?
I think QE is a good place to focus and to think about. You know, right now I think we've got a good policy in place where interest rates are extremely low. We're expected to keep them there for a long time, which I think is appropriate. You know, we have our QE program in place with a substantial amount of purchases. I think that's appropriate. We're still in the middle of the crisis, even though I'm trying to look ahead to a point where this will come to a close and think about how the economy will develop from there. You know, I think that's a good focus, and I'd be remiss if I didn't also mention the 13.3 programs, which are the emergency lending programs that were set up in the March-April timeframe to keep us out of a financial crisis on top of the pandemic. Those have been quite successful. If you look at the St. Louis Fed's financial stress measure in March-April, it was approaching the highs last seen in 2008, one of the worst financial crises of all time. But now those same financial stress measures are back down to normal levels, and certainly the January, February pre-pandemic levels. So I think we've been very successful on that dimension. Like I say, the crisis is still rolling on here, so you never know what might be around the corner, but so far so good. And I think we could do more in that direction if we had to. That's all backstop funding and has kept those markets moving in this situation. I think that's been extremely successful in the U.S.
Deputy Governor Wakatabe, the Bank of Japan has, of course, been a pioneer in various aspects of monetary policy, including the commitment to overshoot inflation. So arguably, the Fed simply followed the BOJ on this one, if I may be overly simplistic. But in Japan's case, it hasn't been very successful in terms of lifting inflation expectations and realized inflation, of course. So if the same, I guess the same question to you as well, if the BOJ was coming to the conclusion that more was needed, what more could that be? What would be the next step if you needed to do more?
Thank you. Yes. First of all, I think that after 2013, that there was a sort of jump in the inflation expectation. Then it gradually sort of dies down. I mean, that's still, I think we still maintain the sort of the non-deflationary environment in the sense that the CPI in Japan has not been falling sort of continuously. But so in that sense, you know, that we are not totally successful in achieving 2% inflation target, but we are kind of, you know, half successful in terms of ending the sort of deflationary situation. But having said that, we are still facing the danger of falling back to deflation. And also as the real economy is quite weak. And of course, we are expecting the economy to recover, but maybe that the recovery pace would be quite slower. So that's there's a natural question that you ask that what could you do more on top of that? Now, the one thing that is certain, well, two things are certain. That we have already sort of launched set up so many sort of tools and programs, so that on each front that we can do more. And now that's the how and the timing and the size, of course, do depend on the circumstances. But we can, I can assure you that, you know, we have already set up the whole bunch of tools and programs so that we can you know, strengthen each of them. And another thing is that if anything taught the BOJ, us, from the last 2 decades or so experience, that we have to be innovative. Okay, whenever we think about the sort of the engaging in the monetary policy, that we have to think about other newer, inventive, innovative way to engage in monetary policy. So in that sense, you know, that we are still not losing that fighting spirit.
And then the second question, if I may, in terms of a stronger yen, I guess has been one of the threats for the Bank of Japan. But maybe there has been some relief that, in fact, the dollar yen has been fairly stable despite this global pandemic, which would have been an environment where one could have imagined the yen to strengthen more. So what role plays the exchange rate in your thinking, and how would you react to a scenario if there was a stronger yen appreciation?
Now, of course, that we don't target the exchange rate, but having said that, of course, exchange rate is extremely important component, which affects the Japanese economy quite significantly. So, and of course, that monetary policy would work through several channels, but one channel should be the exchange rate channel. So in that sense, you know, we keep following the exchange rate movement very closely. And we know that I can assure you that the real question is that not the exchange rate movement per se, but the impact of that movement on the inflation dynamics. So, and if we judge that the inflation dynamics would be further eroded or weakened, then of course that's the time we should think about another sort of action. So I think that the exchange rate itself is not the sort of the marker for action, but I think that we should be really careful about the impact of that exchange rate on inflation dynamics and the employment and income of the national economy.
Thank you very much. Let me go then to Governor Centeno for a couple of questions on the ECB side. And in particular about the Pandemic Emergency Purchase Program, the PEP, which is well known to have these two functions. One is the market stabilization, the other is the monetary stance. How you see the future of PEP, how long it can continue, and at which point it will be kind of required to talk about the transition towards regular asset purchases, and how you see that transition once it comes.
Well, thank you, Beat. PEP is a very important program for us, and it actually had a quite substantial impact in markets, and it achieved the goals that and the reasons why it was designed that way. And here, of course, I have to call for one of the most important characteristics of PEP vis-a-vis other programs of the ECB, which is its flexibility. It's not only the size, but it's the flexibility embedded in PEP. My evaluation from the debate, I had the opportunity to have already in the Eurosystem, is that we agree on these characteristics and on the effect that PEP is having in our economies. And PEP is designed to last for quite some time yet, covering the most important period of the recovery. And I think we are going to certainly evaluate it in the next few months in order to understand what exactly can be done with it, especially in terms of the period that is not already covered by PEP. But I think we are very comfortable with it as we speak, and flexibility will continue to be one of the key words in terms of designing monetary policy in Europe.
The second question would be around negative rates, which you already mentioned briefly, and I heard maybe a sense of caution there when you mentioned side effects as well. But do you see a scenario where you would want to go further than the minus 50 basis points that you already have? I think that's a possibility.
Well, my sense of caution was a little bit academic in some sense. We always need to evaluate the counterfactual in our process of policy decision making. I think we have a set of tools today that is very powerful. And it is really attached and explains I'm going to say, the quality of the recovery. As Felipe was saying, we actually had a very painful recovery from the previous crisis, with second waves of effects in some countries, as we all remember. I think we are all pretty much focused on avoiding that. The design of this specific policy that you mentioned and the effect of the reversal rate is, I think, very carefully followed at the ECB level, and I think we will continue to evaluate this counterfactual of these policies and adapt it. Adaptation is also one of the keywords that I used in my introductory statement. So I think, honestly, this is something that we need to be following very closely in the future, because it hinges quite a bit also in the profitability of the banking sector in Europe. Thank you.
Thank you very much. Then again, Professor Larrain, I want to ask you a question, given your experiences on the more political side in terms of fiscal dominance. This is something that investors are very fond of debating in terms of the future for the central banks, in the sense that there is this notion that fiscal spending is free, well, as long as rates are at zero, but if and when the time comes to put rates up, it might become very painful, and then that political pressure that you mentioned might not be only on governments, but also on central banks. How do you see that threat of fiscal dominance?
Well, thank you, Beat. What I see here is there is a big pressure, and there has been in all countries a big pressure from the political side for fiscal action. The more direct part is on the fiscal side, as long as we have autonomous central bank. There is a difference between countries with autonomous central banks and those that do not have autonomy. In some countries in Latin America and the emerging world, the central bank presidents are people who have the trust of the president of the country or the prime minister. So in those cases, those central banks are much more influenced by political pressure. In the experience of autonomous central banks, yes, there is a general feel for and a general call for action, but I think the more direct pressure is felt on the fiscal side, on the fiscal authorities. The issue that you mentioned about when you are at low rates, this is an issue that has been mentioned all over in the discussions. If we have interest rates at, we can borrow at maybe 2%, which is significantly higher than what developed markets could do. But if we can borrow at 2%, then let's raise the level of debt. But as you say, once there is a moment that these rates will not be there for long, and then you have to start seeing some kind of fiscal consolidation, in the future, because otherwise, I think the idea that fiscal spending is for free is completely wrong, and it's wrong because first it starts building up, and second, you have the risk of rising interest rates, and then you have to turn over your debts in the markets, and you cannot just go ahead and pay, and you will be turning over at higher interest rates. You're already seeing some projections of major investment banks that that the rates that we have on longer paper are unsustainable. Like the 10-year yield, if you see projections for 1 to 2 years, they are well over 1%. Some of them are over 1.5%, and that is for the US. And if you look at the emerging world, then you have to add the spreads that are charged for our countries, emerging market countries, to go there. So my point is, it's a very good part of the institutionality to have autonomous central banks that cushions the central banks from the political pressure, but then the political pressure goes to the fiscal side.
And the second question to you would be on inflation. I must admit, I don't know on top of my head where inflation is in Chile right now. You did mention that you thought for the US inflation expectations were not too bad, but how confident or not would you be that in Europe, in Japan, and kind of in the developed world more broadly, we would see inflation over the foreseeable future?
What we have seen over the, if we judge by what have seen in the past, you know, and you already mentioned it, and it was on Mr. Deputy Governor Watanabe's issue. Sorry, Wakatabe. I should, you know, sorry about that. Watanabe's comments. The fact that it has been very difficult to get out of the zero inflation or the negative inflation in some of these economies, in some of the major countries. So the US, I think, is in a different league here than Japan, and the EU is very close to zero with, you know, I think the last reading of the inflation was negative in Europe on a 1-year basis. So you're already, you know, there. You are not at zero, but you are below zero. I think that, in fact, in spite of the fact that you have these massive monetary increases, that you don't have, you probably have to do something more, something else, you know. And here, I think the issues of the guidance, you know, how you talk to markets, the credibility, how do you make credible, which is one of the things that we've been discussing, how do you make credible the idea that you want to hit your targets, you know? And I think on that question, the US is much closer than what you're seeing in other parts of the world.
Thank you very much. I think we have time for one round more with just one question each before we wrap up. And I, of course, try to be as difficult as possible. So I'm sure you will understand. And again, let me start with President Bullard. You know, one question when you do my job, talking to investors all day long, one question that always comes up is what kind of 10-year US Treasury yield will the Fed tolerate? Okay, that's not a very sensible question to ask you, but in terms of the steepness of the curve, which is a genuine question for central banks, you know, on the one hand, you want to keep yields low across the curve because that's stimulative. But on the other hand, you want the market to push yields higher if it's a reflection of growing optimism. So how would you kind of deal yourself with that dilemma in a way that you want to remain accommodative, but at the same time, you do want the market to signal positive expectations?
Yeah, we actually talked a lot about the slope of the yield curve over the last couple of years pre-pandemic. And as you recall, the yield curve was inverted in the summer of 2019 and was very flat for a lot of that period. I was taking a negative signal from that. You know, that tends to be a very reliable signal that the economy will slow down or go into recession. It actually turned out to be true. I don't think for the reasons markets were thinking, but the pandemic came along and put us into recession. So now you've got this positively sloped curve, which I do think reflects some optimism about the future state here, that we can make it through. I understand there's a lot of downside risk. Things, you know, you're in a crisis, things can go in many directions, but we've had a very good fiscal response in the United States despite dysfunctional politics, borrowed on the order of 14% or authorized borrowing of up to 14% GDP. Now looks like the US economy at the end of the year will only be down about 3 or 4% on national income and therefore on household incomes. So if all you wanted to do is borrow and then use the proceeds to keep households whole and allow them to pay their bills during 2020, we certainly have enough resources to do that. So if we can, you can get through this. I also think the pandemic's been managed. People are very nervous, and I understand, and it is a crisis, and it is a human tragedy. But in the big picture, we have brought fatalities down dramatically, and they're likely to stay at the low level, both because policymakers will react to keep the pandemic under control, and also because individuals that are most vulnerable will take their own actions to stay out of harm's way. And between those, I think we will not have a second wave. That's why I've been more optimistic about this. So, this is partly reflected in yields, but the market has to make a difficult judgment about those downside risks versus, at some point the pandemic comes to an end, and how good is the economy going to be in that state? I think that's a great question. I just want to emphasize one other thing in that calculation, which is that, people talk about permanent damage to the U.S. economy, permanent damage to the global economy. That's very appropriate to talk about that. But a lot of the U.S. unemployed are on temporary layoff. They're self-described as being on temporary layoff. A lot of those people do get recalled. The probability of going back to work is much higher than those that describe themselves as on permanent layoff. So there's a recent paper that just came out by Bob Hall and Marianne Kudliak at Stanford and the San Francisco Fed that talks about this. Very different labor market dynamics than what you're used to thinking about for recession. So I think there's a lot of prospect that you could get fairly good labor market outcomes, continuing relatively rapid declines in unemployment, and a good outlook, therefore, for the U.S. economy. That will affect our crucial 10-year benchmark, and we'll see if we get yield curve steepening going forward.
Thank you very much, Jim. Deputy Governor Wakatabe, the last question from me to you would be in terms of the negative rates, the effectiveness of negative rates in Japan. How do you assess? I mean, there's a clear sense that the BOJ made this step, but then obviously didn't go further, quite possibly because the impact was maybe stronger than expected. I mean, is there a scenario where you think you could go further, or what is your overall assessment so far?
I think that we do not rule out the possibility of going further down the negative interest rate, but also that and after the introduction of the negative interest rate policy, we have the so-called yield curve control, and actually we are buying ETFs and JOEs, and also we have launched sort of the special sort of lending program for this COVID-19 crisis, so that we are actually back financing the financial institutions. So in that sense, we are putting more liquidity into the economy through several channels already. So in that sense, that we are not ruling out the possibility of using the negative interest rate part, but that of course must be sort of thought or judged against the background of the whole sort of yield curve control program, so that what we are targeting is not only the shorter end of the yield curve, but also the mid-range, the 10 years yield curve. So in that sense, we have kind of evolved our policy tools from just using the negative interest rate policy to the whole YCC scheme. So the question is that would we change this YCC or slopeness or the midpoint 10 years JGP yield. That's still a possibility, I think. That's if we need to do more financial monetary easing, that's on the table.
Thank you very much. And then for Governor Centeno, in terms of the ECB strategy review, which of course, as you say, has just kind of restarted, how much inspiration do you take from the Fed for the outcome there? I'm sure you don't want to preempt any of those discussions, of course, but average inflation targeting, how much or how possible do you think that could be for the ECB? Is that something that you would potentially take as a template?
Well, thank you, Bert. You're right. The debate has just restarted, as I mentioned, and it's not possible even to be preemptive on anything, because it's going to be a very rich debate. We have seminars every month, and the agenda is quite heavy and interesting. Of course, the experience that we take from other central banks, and namely the Fed, it's important for us. It's something that we also have to base our decisions on the most up-to-date practices and theoretical dimensions of the situation. But of course, Europe has a particular situation of its own, given the mandate of the ECB. One of the issues that I personally see as most relevant for us in the context of the European Union and the Eurozone in particular is the interaction between monetary and fiscal policy. This is something that is very important for us to debate and to take here the benefit of all communication that the ECB already made on this issue in the previous years. I may quote President Draghi and President Lagarde on this very easily. So I think this is one of the issues to look forward, in my perspective, for the upcoming debate. And I see here a lot of scope from our own policies to promote Europe's recovery and going forward in terms of coherence of policies. This has to be made always under the umbrella of ECB policy independence, as we take that very seriously. But a more open debate in Europe is very important, and we will give our own contribution. Inflation targeting is certainly at the core of our mandate, notwithstanding the fact that the European Union Treaty also calls for the ECB to take into account issues like full employment and more structural issues relating to our economies. So we will need to play with all of them. This is going to be a very rich debate. Thank you.
Thank you very much, Governor. And then the last question also for Professor Larrain. In terms of exchange rates and maybe spillover of developed country central banks to emerging markets. I mean, over the last few years, there at times the notion of currency wars has come up. Are you worried at all? I guess emerging market currencies are relatively weak. Are you worried at all that there could become more tension could build up once again as all these large central banks are extremely dovish right now?
Well, it's very interesting because when we used to talk about currency wars, you know, a few years from now, it was in a process of very strong appreciation of the currencies of emerging markets, and now we have the opposite. So what we have seen now, and I think it's a more pragmatic view, and I take you know, responses from previous crises. In previous crises, some of the countries had fixed exchange rates, and they tried to fight against the markets in trying to maintain the exchange rates. And in that process, they increased interest rates. And in the increasing interest rates, you know, many times was not sufficient. So they had to let the exchange rate go. But in the process, they made a big damage to the economies. What we are seeing now is that, I'm making a general statement, you can find exceptions here, but I'm seeing many more countries moving into floating exchange rates, letting the currencies depreciate, taking a big part of the cushion from the exchange rate rather than fighting the pressure on depreciation. And in that process, it's important to mention, if you let the exchange rate depreciate, you're not using your interest rates, you're not using your international reserves. You know that in many cases, you know, were used in the process of fighting the depreciation. These depreciations have proven to be, on my view, you have more depreciated currencies, but you have very low interest rates throughout so interest rates, of course, they're not as low because you have the country risk. In some countries, you have a country risk plus exchange rate risk, you know, to add to the base, you know, to the base of the interest rate in developed markets. But I think that right now, exchange rate policy is much more pragmatic, is much more attuned, and it has been much more flexible, you know, in responding to the current pandemic. One thing that we have not discussed, but let me just raise because it's behind any projection, which is so uncertain right now. And part of the uncertainty is because you have the second waves, you know, the second wave of the pandemic undergoing in many of the regions. You know, you have a second wave in Europe, you have a second wave in the US, you have a second wave in some of the emerging markets. And we don't know, and we judge by other pandemics like the Spanish flu of the early 20th century, it had 3 waves. So a lot of what we're saying here in terms of macro policies, monetary and fiscal policies, when do you take them away? When do you start, you know, phasing out the current monetary and fiscal stimulus has to do with this, the persistence of the pandemic, the second waves and third waves. Thank you, Ben.
Thank you very much, Felipe, and thank you to all the panelists. I'm afraid we have run out of time, but I'll hand over to Mark for the final word. Thank you.
Well, thank you, Beat. I think, yeah, thanks so much for a great panel, great moderation, and thanks to all our speakers. I think hopefully it was a great exchange of view, and I know it's quite late, and I appreciate your time. I know the calendar of events is rather different these days than in previous years, but I really appreciate your commitment to continue to join our seminars, and we look forward to seeing you again in person. Thanks, good night, good afternoon, and good morning to some of you. Bye-bye. Thanks.
Thank you, Mark. Bye-bye.
Thank you.
Bye to everyone.